There's a look at two of the most high-profile stocks on the TSX this morning. Cenovus Energy trading down now by 12%. Husky Energy trading up by 6.5%. The news is, of course, that yesterday the two companies announced a friendly transaction in which Cenovus will acquire Husky. For some expert insight, we're joined now by Gwyn Morgan. Gwyn Morgan, of course, is a very familiar face to Canadians on this sector. He's the former CEO of Encana. Encana was the company from which Cenovus was spun out years ago, and we're going to talk to Gwyn Morgan now about this deal. Gwyn, before we get to some specific questions, do you have any broad reaction to this announcement?
Well, let me give a personal reaction first. I mean, the two companies that came out of the company I founded, Encana, that's Encana itself, which kept its name until it moved to the United States, and Cenovus were the two companies that came out of what I founded. I guess it would be no surprise to you to know that I was a great Canadian champion of Canadian headquarter companies, and I was really disappointed when Encana moved south. So I'm really happy to see that this company, this other company that came out of Encana, is staying in Canada and growing and building here, and is going to be even stronger after this merger.
One thing chief executive officers are expected to do by shareholders, chief executive officers and their management teams, is get the price right on acquisition. Some of the early reaction, it is very early reaction from analysts, and it looks like from investors in the marketplace as well, is that Cenovus may be overpaying here. Do you agree?
Well, that normally is the case when one company buys another. I mean, the time we did the deal with Pan-Canadian, which is the time the biggest merger in Canadian history, it was a straight merger of equals. And I always said that never could be possible again, because it's very difficult to convince shareholders on one side or the other that they shouldn't get a premium. And but so I think that it's natural. The real question, of course, will be going forward whether the synergies that the companies have together make sense. And I might just say that we built Encana around what I call a multi-stool platform, and that means that if you're just, for example, producing gas, or you're just producing oil, or you're just producing heavy oil, you're already vulnerable to change in any one of those things. And so we tried to have a combination. And the way that Cenovus produces heavy oil is in situ, that is using the steam-assisted gravity drainage process that uses gas to heat the oil. And so we had a natural hedge as well there, because if the gas prices went down, we made more money on the oil. And if the gas prices went up, the reverse. So having and then adding to that, which is what this deal does, is provide the refining margin benefit. First of all, the access to the refiners, which is very important, and some pipelines, by the way, and some upgrading. So it provides some downstream hedges and downstream situations where if the oil prices, for example, a wellhead drop because of deep differentials, you make more money in refining. So I think that really we have here, what Cenovus is building is a four-legged stool, and it's a lot more stable than a one- or two-legged stool.
Share prices of both companies are a fraction of what they were years ago. Does that fact make a combination almost inevitable? Husky shares trading at Friday's close at less than $3.50 per share. That's versus $20 plus years ago. Is a takeover inevitable after a share price erosion like that?
Yeah, I think so. I think, hopefully, and being optimistic about this, general situation, as we get more pipelines, more access, as long as we can keep fending off Ottawa, which is a tough thing to do, the industry is maybe poised to start coming back as we get more access to market. And so this is a time of very low prices, and I wouldn't be too worried about, a premium trade at this point.
Cenovus CEO Alex Pourbaix has made it pretty clear that non-core assets will be sold off. He says people should not be surprised to see that take place in the months or perhaps years ahead. Any thoughts on which assets are likely to be sold, and what type of reception will those assets get from would-be buyers?
Well, that's a good question. I mean, I think, one of the things they have, which Husky brings, which is very interesting, is the Asian gas assets in the South China Sea and Indonesia. Now, they may have a lot of future value, but they may be having more value now than some of the Canadian assets. So they could be on the block. Who knows? I mean, I'm not trying to say one way or the other, but it is a difficult time to sell assets, and they have to be, if someone's going to buy them, first of all, they have to have the money right now, which is a real question. And the other thing is, of course, they have to be really, truly non-core. Otherwise, you're hurting your future. So I think that, the fact that they did this as a stock deal lessens the importance of reducing the debt at this point.
Will we see more of this? Will we see more M&A in the sector?
Sorry, I didn't quite catch that.
Will we see more acquisitions in the near term in this sector? Does this deal create a sense of opportunity among other companies?
I don't know. I don't think that generally mergers or acquisitions are sort of something that catches on and goes elsewhere. It doesn't translate or transmit on its own, but it's the environment, and it could be that companies see assets that are valuable, and if they can do a stock deal without putting up cash, then they might be able to move and build at this point.
Any surprise that Li Ka-shing is on board with this transaction?
Well, it's hard to know for sure, but I think that he obviously is. One of the things, by the way, that I would mention is that when I first heard of the deal, I was a little bit worried about that largest shareholder and controlling the company. I haven't seen the documents yet, but I hear they have some sort of a standstill agreement and so on in place to really, I would guess if I was Poro, I would have put that in there, because I want to make sure that a shareholder doesn't have to be treated differently than others.
Okay, finally, you've been the CEO, of course, of a company that has made acquisitions. What are the challenges and the opportunities of the Cenovus management team if this deal is completed, which we expect it will be? What are the challenges and opportunities of this management team over the next year or so?
Well, the challenges, I've made quite a number of acquisitions in building Encana. The challenge is always being able to demonstrate that you got it right, that in fact the value is there, and that you can realize on that value sooner or later. And so there's, I have to be candid. I think that Husky's assets are some of them are really good and some of them aren't. That's typical of companies, but I think that what they really have to do is figure out which is which and capitalize on those going forward. And some of those that aren't may fit better somewhere else or whatever, but it's always a challenge, because when you make a deal like this, everybody's, as the old saying goes, from Missouri, you have to show me, and it's up to them to do that.
Gwyn Morgan, we always value your insight. Thank you very much on our top line story today, the acquisition of Husky Energy by Cenovus. Gwyn Morgan, of course, the former chief executive officer of Encana Corporation and still a leading voice in the sector.